Joining us now is Philip Moffitt, who's Managing Director and Head of Asia Pacific Fixed Income at Goldman Sachs Australia. He's with me in Sydney. I mean, yes, JP Morgan, Citigroup saying we're going to see the steepest rate of tightening since 2006. That is not what the bond market is telling us.
Well, no, and it's not actually such a big call considering policies being
that's
eased.
When QE started.
Yeah, exactly. So. Policies being eased everywhere for 10 years almost. So the bond market, I think, well, certainly it's forward pricing that rates will rise. It's not forward pricing as much as the central banks are telling us that they will do, particularly the Fed. But the long end of the market's reflecting pretty subdued global inflation outlook. And so it makes sense that the curve would be flattening whilst short rates are being tightened a bit.
Yeah, that's what I wanted to bring up, this next chart, 60, 77. That's been the story of the year, right? Where's the inflation? Yeah. We kind of jokingly talked about the BOJ being nowhere near, but really no one is nowhere near. It's been this global phenomenon. So, does this leave central banks in a sweet spot where they don't have to actually hurry?
Well, pressures are building. And they're building slowly, so I'm not being
Financial
factuous.
risk pressures?
No, inflation pressures. So unemployment rates are falling. The older Phillips curve argument still applies to some extent. There's a big argument about how much it applies.
Yeah.
But US wage rates are rising. The
2.5%.
Yeah, not very much.
Yeah.
If we keep growing at this rate for another 12 months, unemployment rate in the US will be 3%. We can see some signs of it in different places. In Japan, wages are growing a little bit, so it's not a lot.
Is there a risk
but
that the
policy's
transmission
really
happens
easy.
faster?
Yeah, of course there's it could be that it's not. Well, it's never a linear relationship. And central banks, I think, are transferring the focus a little from headline inflation to the level of unemployment that they can see, or output gaps. Basically output gaps in unemployment rates. And one thing that I think gets overlooked often is that we look at the US, or you look at Japan, or you look at Europe. But actually, if you look at the global market, about 90% of the economies we cover are running with their manufacturing purchasing managers index kind of numbers over 50, which is a really strong, unified global growth environment. So although no single economy is growing really strongly, the global economy is actually growing
into the
really
synchronised
well.
growth story.
Well, interest rates are a global price on money. So if growth everywhere is strong and demand for capital goes up, there's a big capex cycle underway globally, and the labour markets are tightening, at some point there will be some price pressure. And given that central banks have very easy monetary policy stances right now, it makes sense to us that they'll keep nudging gradually towards neutral.
Is the tax reform or tax cuts in the US going to be impactful?
Yeah, if they're passed, it's definitely, they'll be adding to demand to some extent. There's a big debate about how big the multiplier effect of those will be. If most of it's focused on corporates, it's actually taking away from consumers. As I said, there's a capex cycle underway in the US, which looks like a really traditional capex cycle. Capex growing at about 2 times nominal GDP, which is kind of the long-term average. If corporates bring some money home at the same time, we'd expect that to continue and that to have a minor positive impact on growth.
You sort of front-ran me and spoke about the flattening yield curve, because I'm sure that's, people throwing up their hands and ask you what's going on. But I want to throw up this is the 10 and 2 spread chart, 90.49. You're not particularly concerned about it. You don't look at this and go, this portends something horrible is about to happen.
No, look, I think long-term inflation expectations are very low. Actual realised inflation's quite low. The Fed is telling us, and they're moving in a way to make us believe that they're going to control any kind of rise in prices. They're sort of moving gradually. And that's convincing the market that there's no need for a big long-term yield premium. The other thing that's happening is that, particularly in the US, there's a pretty substantial demand for long-duration assets, particularly from defined benefit pension schemes. And although QE is coming to an end and the supply-demand is shifting in long-duration assets, there is, we think anyway, quite a lot of demand for long-duration assets at somewhat higher yields, but not a lot higher yields. And the market, I think, understands that, or that's what's been played out with this kind of curve flattening that's going on.
For the Aussie,
yeah,
Is next year going to be a bit more painful?
Yes.
The RBA's kind of stuck. Right?
Well, they're stuck. Basically, they're on hold. And the Aussie went up. I think last time I was here, the Aussie was trading over 80 or something, and it just was ridiculous. And I talked about the RBA's not going to tighten. At that point, people, even earlier I heard you say something about giving up on tightening expectations. I mean, that's just a crazy thing. The housing market's slowing. Huge levels of household leverage here. There's no wage growth. The real economy is actually pretty sluggish. And I think the RBA is on hold for a substantive period. So we'd expect a crossover in short rates.
Or?
No, it's not recession talk. Unless something, very asteroid, what was your phrase? Something like that could catapult us into a period of downturn. The currency is going to come down. It has come down. When it was 80, I think we were talking about low 70s. I think that's still probably about right. And a 10% move on the currency gives a lot of cushion.
Outside your remit and most people's, to be honest, but what does the cryptocurrency craze tell you about what investors are feeling at the moment?
Well, people love to chase a price, so I think there's an element of that. I don't know how much volume needs to get done to actually drive this Bitcoin price up and down as much as happens. I've just come back from a strategy meeting in New York, and it was one of the topics we talked about, and nobody can kind of get their head around it, except for the fact that because it's not really monitored, it might be a very attractive medium for people who are doing things that they don't want
unscrupulous
known about. I think it just tells you that credit's still cheap for people. Confidence is high, so consumer confidence globally is very high. It's only really Australia and the UK where the consumer's a bit soggy. Everywhere else they're doing really well. And they're looking for something else, given stocks have pushed up and they're worried about bonds.
So it's a liquidity story?
Yeah, I think so. It's a bit of a mania and a liquidity-driven mania.
Pleasure as always, Philip.
Nice to see you.